Welcome to the IRS Debt and Audit Podcast with Brian Loughrin.
Hello and welcome back to the IRS Debt and Audit Podcast with Brian Loughrin. Brian is a seasoned tax attorney based in Tampa and the founder of Tampa Tax Relief. For more than 25 years, he has helped individuals and business owners across the country resolve serious IRS problems, from audits to tax debt to cases in the U.S. tax court. I'm Evan Mack, and today we're talking about the trust fund recovery penalty and how unpaid payroll taxes can lead the IRS to pursue individuals personally. Brian, sir, welcome back.
Thank you, Evan. Good to see you.
Good to see you as well. So, Brian, when payroll taxes come up in IRS cases, the term trust fund recovery penalty often appears. What does that term actually mean?
Well, it's a little bit of an explanation here. So let me just kind of step back for just a moment and kind of characterize why it could even occur. A business that has employees where they run payroll, as people know from I tell people from the time you were in high school, your first job where you got your first couple paychecks and back in the day, and the taxes were taken out. Well, obviously the employer is responsible for submitting those taxes to the IRS. That's part of being in business. And in certain instances, you'll have an employer or company that fails to do so. They don't submit the withholding to the IRS. And it's for various reasons. At least from my experience, it's been businesses that have struggled financially for a number of reasons. Maybe they've lost a contract. Maybe something has happened to the industry that slowed down their ability to, take in sufficient funds to cover. And these are usually businesses that have a pretty payroll heavy type of business, meaning employment, or the wages, if you will, is in many cases the largest expenditure that they have in any given pay period, month, year. And so they run into difficulty and they don't submit the taxes. Well, that happens. That's a hell of a problem. And the IRS says, hey, wait a minute. Roughly about 80% of what the IRS takes in is through payroll tax withholding. And if you think about it, if you have a business that 80% of your income is from a particular source, say you have a restaurant that you cater to a certain clientele, local clientele, 80% comes from a particular location, or any type of business where you can drill down and see 80% of your income from a particular source. If something were to happen to that source, you would want to take quick action on it. You would want to move to make sure that that source of income was doing what they needed to do. You were doing what you needed to do. So the IRS is set up to be very aggressive in the collection of unpaid payroll withholding from the employers. And so the IRS will reach out to an employer and say, through letter, usually start with that, say, hey, you didn't send in these deposits, you owe this money, what's going on? Well, it doesn't necessarily need to get to a substantial amount. It doesn't need to get into hundreds of thousands or millions of dollars before the IRS is going to oftentimes assign a revenue officer. And that's what we talked about in a previous podcast. They'll assign a revenue officer to that particular business and say, hey, wait a minute, what's going on? You owe us X amount of money. We need to get that money. This is a serious situation. And so in those cases, the employer says, look, here's the situation. I don't have the money. Believe me, if I had it, I would pay you. I would like you out of my life. I'd like to not have to hire a tax attorney to help me, but I don't have the money. And I'm not in a situation where I can just come up with the money overnight. And the IRS says, look, we understand it happens. I don't know what the statistics are on businesses in America. I know that the majority of new businesses fail within a year and so forth. I think we've all heard that for decades. And I'm sure some truth to it. But the IRS says, look, if the business can't pay it, and assuming the business is still viable enough that they think it's a business that can sustain itself and maybe get back on its feet going forward, the IRS will say, well, we want to make sure we're going to get paid. So about 100 years ago, Congress changed the law that said the IRS could look to the responsible parties in that business and hold them personally liable under their name and social security number for those same unpaid payroll taxes. And that's called the trust fund recovery. And so that's the basis of it.
So how do payroll taxes differ from other types of tax debt in the way the IRS views and enforces them?
Well, again, they'll be very aggressive in the collection. And I tell my clients, which again, the majority of them are small business owners, I'll say, imagine if 80% of your income came from one particular customer. I said, and that customer called your office. Okay, you'd probably jump across the desk to take the call, right? I mean, that's 80% of your income. You're geared to be very responsive. And so the IRS is in the same fashion. very responsive or aggressive, if you will. And it makes sense because that's the bulk of the income that the IRS collects. And so they will look to what I say is their responsible parties to possibly put it under their name and social security number.
So when the IRS begins considering a trust fund recovery penalty, what kinds of questions are they usually trying to answer about the people involved in the business, Brian?
Well, it's a kind of a general term, but they'll say responsible parties. Now, for most of our clients are small business owners. So in the IRS, if you have annual revenues of 20 million a year or less, it's deemed as a small business. And that is obviously the majority of our clients, small business owners. So they fall in that category. So really, even under that umbrella, most of our clients are owner operators of their business, meaning they're not silent partners or they don't just step to the side while things are taking place. They're actively involved in the day-to-day of the business. And so in that case, it's obvious that they're a responsible party in the sense that they're making financial decisions for the business. And this is where a lot of people get a bit mixed up, because I've had situations in the past where you have one or two, or in one case, four business owners that owned equal shares of a corporation. And the responsible party was not deemed to be any one of them, but rather an in-house office manager, bookkeeper. And this person had no ownership interest in the business, was not an officer of the corporation, was just simply an hourly employee. But this person determined when the monies came in, what bills got paid first, in what order, and so forth. And this person was responsible for processing the payroll and everything. And that's kind of a rare situation. But most of the time, the responsible party is going to be the owner or owners of an owner-operator business.
So in many companies, several people, may have financial authority. How does the IRS determine who might be responsible when the payroll taxes go unpaid, Brian?
Well, that's just it. That's why they'll kind of drill down, and that's where all the questions start coming in. And there's an actual form that they fill out, and with the people that they deem possibly responsible. And that's a big part of where we come in, because what I tell people when they call is how you respond to these questionnaires, and just the different information the IRS is looking at. There's certainly an appropriate way to go about responding to it, um, because you don't want somebody being held under the trust fund personally liable if they weren't making business decisions. But the IRS comes in, they have to ask those questions. Look, the IRS wasn't there. They weren't in your business for the last 6 months or a year or what have you, watching what you do. The only way they're going to make that determination is going through a formal interview process. And I've been through many of those with my clients. And in certain cases, people step forward and they say, look, I own the business 100%. I've got a staff of 10 people. I'm responsible for payroll. I handle all the incoming money, outgoing money. It's all me. And in that case, then it's not, there's not a mystery to it, but it doesn't necessarily lessen the severity of getting that, essentially that same tax bill under your name and social security number. And that's where sometimes people get confused. They're thinking, well, wait a minute, if I owe the IRS, or I should say the business owes the IRS, say $90,000, and they come in and do the trust fund, and all of a sudden they say, okay, fine, you're going to be responsible. So you're going to get a bill that it's not quite equal to 100%, but it's about 90% of it. They'll say, okay, you owe 81,000 in trust fund. The IRS is not trying to collect 90,000 from the business plus 81,000 from you. They're not double dipping or trying to get twice the money. They just want the 90,000. But they're not going to stand by, because if a business closes and say they go out of business and there's no assets, there's no inventory, there's no accounts receivables, the business closes up like that, the IRS says, well, we don't want to be completely locked out. So they'll go after that individual for, as I say, it's about 90% of the unpaid payroll tax.
So can you describe a situation where someone was surprised to learn the IRS considered them personally responsible for payroll taxes?
Well, it's usually somebody working in the business that's not an owner and not an officer of the
Wow.
corporation. Look, a lot of our clients are in, kind of blue collar, hands-on type businesses. Okay, everything from roofing companies and plumbing contractors, electricians, drywall, just pavement companies. I mean, where you're out in the field working, doing the work, and you have an office staff that's taking the calls and setting up the business and all that. And so a lot of times, as these businesses grow, the people that are really good at doing the work aren't always at the best at managing the business side of it. So they'll hire people to help. And in some cases, they'll, kind of hand the keys to that person and give them what I might consider to be too much financial responsibility, letting them make too many business decisions. And again, you get going and you got more work than you can handle, and you're up early and you're working late and all that stuff. He said, well, there's just no way I can handle the office and do all the work. And so people are wanting to build a business. And so they'll hand too much autonomy to the office people. And so you have a situation where the IRS says, well, we want to interview your office manager or your in-house bookkeeper. And that person is just flabbergasted. Oh, I don't have any ownership interest. I'm an hourly employee. I'm not an officer of the corporation. Well, that person's been making decisions that when you have that money coming in every month, what bills get paid first. And that's something the IRS will say. They'll say, well, listen, were you making the maybe the rent or mortgage payment on the facility, the business office? Were you paying for materials? Were you paying for software, fuel, operating expenses, different things? And if the person says, well, yeah, we work because we have to stay in business. So it can filter down to that. I will say that's really a small minority percentage of the situations, but when it does happen, it's pretty surprising to people.
So Brian, once the IRS begins investigating individual responsibility, how does that process typically unfold, for the people involved?
Well, the IRS will say, listen, we want to have an interview with this person. Now, again, so much has changed before COVID. I remember being told countless times, oh, it has to be face to face. We have to meet face to face. Can't do it. It has to be face to face. There's no way we can do it over the phone. And then COVID hit, and then it was, we can't meet face to face. There's no way
Yep.
we can meet face to face. It
Yep.
has to be over the phone. Now it's kind of gotten to a situation where there's almost a little bit of a hybrid where, yeah, they still like to meet face to face, but the IRS more and more is using, online video, like it's Microsoft Teams, I think, is really the program the IRS likes to use. People talk about Zoom, but it's like that. So you have those situations as well. But the thing is this, when I take on representation, I always tell my clients, you don't want to go into that interview by yourself. You could say something that could hold you responsible if you're not responsible. And it is a situation where you have to be very mindful of what they're asking. Because like I say, in some cases, you have people that are very good at what they do. They've built up quite a good business. They have a reputation. They're out there working hard every day. And they've, like I say, handed the keys to somebody else. And that somebody else, unfortunately, hasn't made the payroll tax deposits. And I will say this, there are plenty of situations where the business owner isn't even aware of that till some type of letter is received. And that's because sometimes you have people working in the business that are just trying to play hero ball, and they think that they're going to get ahead of it and so forth. And it's just, if you have a business, it's your responsibility to manage the money. You have to make that your number one priority ahead of actually doing the work, because if you don't keep focused on the money, the payroll tax, the deposits like that, then you're kind of defeating the purpose of being in business, because the purpose of being in business is to make money. And that's true for anyone.
So why do payroll, tax cases often move more quickly or aggressively than other IRS collection matters, in your opinion?
Well, really, because the bulk of their income comes from payroll tax withholding. See, a lot of my clients are small business owners, and they've been doing it for maybe an extended period of time. And
Right.
as I say, when you own your own business, you're managing the business income expenses, your personal income expenses. It's kind of easy to see things through that lens, but the majority of people are actually employees, or at least it's been that way from the history of this country. They're employees of a company, and so you kind of lose sight of that at times, because a lot of times I have business owners that have payroll tax problems that they're kind of at the point where they're not even paying themselves. They're just basically paying the payroll, the net pay to keep the people coming in and keeping the utilities on, and enough money to buy the materials or the ability to do the work that they do. And they're at a point where I've had clients say, look, I haven't paid myself in 6 months. I'm living off savings, or I'm living, very inexpensive right now because I want to get things turned around. And so, again, the system is set up to be very aggressive in collecting unpaid payroll tax.
So Brian, how can the financial exposure change for someone once the trust fund recovery penalty is formally addressed or assessed?
Well, basically, that it's about 90%, or I'll say the same amount, is put under that person's name and social security number, as if they, for instance, filed an income tax return saying that they owed, in my example earlier, $80,000.
Yeah.
And they're thinking, well, wait a minite, that's not right. How can I owe, and so forth? And what I say is this: listen, if you can get the business rehabilitated to the point where the business can make these unpaid payroll tax payments, then that's what you want to do. Because if you try to end up paying it out of your personal income because the bill is now coming under your name and social, if you try to match it that way, you're actually paying what is a business expense in personal after-tax income. And so you're really getting hit twice on that debt from a tax standpoint. So you absolutely want the business to pay the payroll tax debt rather than you individually. But in some cases, when the business is closed and there's no ability to pay, there's no assets, there's no inventory, there's no accounts receivables, um, then you have a situation where that person is saddled with that debt under their name and social. And that's the essence of a trust fund penalty.
And before we close things out, for a business owner or officer who learns the IRS may be, looking at them personally, what should they understand about having a tax attorney involved at that stage?
We've talked previously, it tells the IRS, look, I'm serious about getting this thing resolved to the best of my ability. It may be paying it in full, it may be paying nothing on it, but it lets the IRS know that I'm taking the situation seriously and I'm not just going to try to play dumb or duck out the back door or kind of hope it goes away and cross my fingers. That I'm going to address this situation like I, take it head on, like I have in everything else with my business. I want to tell you one interesting thing about trust fund cases and payroll tax cases is that, and that this has occurred in many instances over the years, and in a couple cases, it's actually satisfied the debt. But when the IRS is assigned to an unpaid payroll tax case, among other things, they'll not only talk about assets of the business and what can they liquidate to pay, things like inventories or an inventory that you can liquidate. Do you have excessive vehicles or things that you can sell and so forth? One of the things they ask about is some accounts receivables. Do you have any accounts receivables that you have been anticipating, but you've not yet been paid? And I've had many situations where clients are like, well, yeah, I've got one or more situations where somebody owes me X amount of money for services or work performed, and they're just not paying me. They just won't pay me. They're not responding to me. And yeah, I could probably sue them, but then, I could hire a lawyer to do it and then pay the lawyer and all this and that. And I say, well, put that together. And then what we'll do is I'll reach out to the IRS revenue officer and say, well, yeah, this, my clients, here's a couple businesses that owe my client X amount of money. And so the IRS will issue a accounts receivable levy to those businesses for my client. And so that business that's failed to pay my client the monies they're owed will get a letter from the IRS saying, hey, any money that you're to pay to XYZ Incorporated, you're to send to us. And it's amazing how those unpaid accounts receivables all of a sudden come payable to the Internal Revenue Service and count against the payroll tax. And as I say, I've had situations where there's been enough unpaid accounts receivables, but other businesses refusing to pay my client for legitimate statements that have satisfied the payroll tax debt. So there's a little bit of a bonus there for the business that's facing a situation like that if they find themselves in that situation.
It's really good information there, Brian. I appreciate your time, sir.
Well, thank you, Owen.
That's it for today's episode of the IRS Debt and Audit Podcast. To learn more about Brian Loughrin and his work helping individuals, business owners resolve serious IRS problems, visit tampataxrelief.com. Thanks for listening, and don't forget to leave a review, and subscribe to the show so you do not miss the next episode. Thank you so much, and we'll see you next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.